Well, thank you guys so much for spending some time today. We know we are the panel that stands between you and drinks, so we're going to do our best to keep this lively and moving and keep you guys really engaged. It's been a really interesting day of kind of this, my apologies to Robert Stack, but this could be titled Unsolved Mysteries, because we've heard about cryptocurrency, we've heard about cybersecurity, fund management oversight, and now I've been covering this industry for 20 years. My name's Matt Ackerman. I work for Investment News. I handle all of our digital content and multimedia. Probably why I'm good at talking. But it's really great to get to be here talking today about is bigger better? And what are boutique managers? Because I think it's kind of a nice mystery to kind of round out the day. So I will be your guide. I'll be Columbo. I've got my own Bloodhound gang up here, folks, and they've got some great insights today on what is boutique management, why it's different, and why it should stand out. So first, let me kind of run down who's here with us, and then I'll let them kind of introduce themselves a little bit. So at the end, we have Carlos Cabrera from Joya Investments. Next to me here is Amy Benstead from Preqin, Ken Schruer from Inception Point, and David Young of Gemini. So to get us started, we're going to run down the line a little bit, and I want to pose to all the panelists the question to get started. What does it mean to be a boutique manager? And Amy, since you unfortunately have to sit next to me, you get to answer the question first. What does it mean to be a boutique manager?
I think it's a very interesting question, and probably we'll all have slightly different answers to that one. So I work in an alternative asset data provider, so I'll be talking about hedge funds today. And the way that we look at boutiques is normally a firm that's doing something unique or something different and focused, and that could be anything from quite a small firm up to a relatively larger firm. So you do see some boutiques which might be approaching $1 billion in size, but they've got a very focused strategy in the hedge space. The interesting thing about hedge fund world is that everybody likes to see themselves as unique, and that's where kind of these boutique shops can be hard to identify, but it's basically a kind of a focused strategy who are doing something kind of different out there in the market.
Ken, what about you? What do you think?
Should I give my background?
Please.
I started in this business in 1983. I'm not just the oldest guy in the room. I'm probably the longest investor in the room. I started investing in hedge funds very early in the 80s and through a company that I created by the name of Kenmar. And more recently, when I sold the business, created a company called Inception Point, which is in fact here to seed and accelerate hedge fund businesses. So what do I consider to be a boutique? First of all, it could be limited capacity. It could be a very niche type strategy, a very tightly defined strategy. We're seeing more and more strategies now coming out that are driven by machine learning, all types of quantitative strategies that have a meaningful future, probably more meaningful going forward than what they've had in the past.
I think to echo a point that both Ken and Amy made in regards to boutique, I think a lot of times boutique gets confused with emerging, and they're different. Emerging, we'll see definitions for emerging managers as anything below $2 billion in assets, as crazy as that sounds, but pensions look at it that way. But as they pointed out, boutique there's specialization, there's a different product offering, a different focus in the marketplace, and I think that's unique in a lot of the funds we see today, which can be very cookie cutter-ish in some ways in regards to strategy.
Carlos, your thoughts?
For me, it's really about one word, it's symmetry. There's got to be symmetry. So what we look for is, our definition of boutique is, I'm looking for sort of alpha generators, not asset gatherers. So there's asset gatherers out there that there's, to me, a lack of symmetry. So we're finding guys that we have symmetry with and that kind of know what their max capacity is and sort of honor that bar. When somebody says to me, we can only manage $250 million and I can give them $100 million of it, I'm very happy, but I get unhappy for managing $500 million 2 years later. So to me, it's symmetry.
Heard some really interesting words there. Unique. We've heard symmetry. Carlos, I'm gonna stay on you for a second here. And how can you guys have kind of an edge over some of the larger players out there? What gives you kind of that leg up?
Oh, it's called speed. I mean, you know, I started in 1992, quick background in the brokerage side of the business. Built a pretty big brokerage business that's currently still operating and sits within ADMIS. It's run by a team of 8 that work for me. It's myself and 2 other guys sit on my asset allocation side of the business. And I think our edge has always been speed. And to Ken, you know, Ken's been doing this as long as I have, is that when you find someone that you like, we move very, very quickly, and we can be the first one without having the handcuffs of, you know, favorite nations calls and all those type of things. We move very, very quickly. So that's kind of our edge, speed.
I think that's a huge edge there. But Amy, sometimes being fast, being unique, having that symmetry, does it give you an opportunity though with institutional investors? From your perspective, is there still an opportunity with institutional folks?
Well, the investors that we track are anything from smallish family offices, endowments, all the way up to pension funds, and you see appetite for boutiques or, you know, smaller firms across all of the spectrum of them. It's really about standing out from the crowd and trying to kind of show your edge to this market and trying to tap into what they're looking for. And I think, you know, there's a lot of funds out there. There's 14,500 funds out there, and 14,500 funds out there trying to market to investors, and for institutions, the challenge is finding those ones. And at the moment, you know, a lot of the money recently has just gone into the biggest funds. About, you know, 13% of all firms have got $1 billion or more in assets under management. They control about 90% of all of the capital. So it's been a huge influx just into the largest funds. But what we are seeing is institutional investors, even the bigger guys like pension funds, starting to look down that size chain and actually looking for funds that can do something different for them. And that's where boutiques who might have a niche or a very focused strategy can actually step in.
So Ken, from your perspective, you know, having been in this space for quite some time here, do you find that the institutional dollars is moving towards boutiques, or has it always been there?
So the statistics that Amy just mentioned
Yeah.
are very, very clear that everybody wants that bigger is better in a lot of institutional mindsets. There's definitely a move towards small. There's plenty of statistics that support the fact that newer, smaller AUM managers outperform the bigger managers. Plenty of statistics. You can find it. You can look it up. You can find it just about anywhere. And it does. It seems to have been and is quite repeatable, both from my time in the business and looking forward. I believe that it is, and it has been, and it will be. It does present an opportunity. You know, Carlos speaks about speed to market, about being able to be nimble and being able to invest with a new manager. To me, from my perspective, the idea of if I'm going to put $5 million to work, or I'm going to put $50 million to work, or I'm going to put $250 million to work, it's the same amount of work, because I care about each one of those investments exactly in the same way. And it's just as much work for me, for my team, to do the homework to get to that point. And so I think that there are great opportunities amongst smaller managers. I think you have to be careful. I think that there is an opportunity to be fast, but I think that but caution. There's a lot. You know, if you want to look at emerging managers, you're drinking from a fire hose.
Yeah.
They're drinking from a fire hose every day of the week. They're coming at you nonstop. And there are ways to mitigate some of the risks, but there's just thousands of them.
Stephen, are there hurdles then for boutique managers, and challenges, if you will, to entering this market, to standing out? What are some of the challenges from your perspective that have to be overcome?
Well, Amy touched on institutional investors looking in the space. At one time, Ken had $3.5 billion in assets on a platform. He had institutional investors. I was his service provider, so.
We know each other well.
So he had institutional investors coming to him because Ken was providing an expertise in being able to access those managers. He was identifying them. And as he said, whether it was 50 to 250, doesn't matter. He's doing that work of identifying. And then he would rely on the operational infrastructure of someone else. I think that operational element's an important part when you start looking at smaller managers, more niche managers, because it's, 64% of fund failures are operational. It's the importance of having that a continuity of operational infrastructure, of service, of information that needs to be conveyed back to the end investor, to the institutional level investor, is critical.
Can I just comment
Yeah,
on that a
please.
little bit? Because David's just touched on something that I think is the most critical path for an emerging manager, somebody starting in the business. I have this philosophy, it's called 60 minutes. You sit in front of a client, you've got 60 minutes of their time. Don't waste a minute of that time when you sit in front of them. So, if you're talking about a new manager, a new concept, a niche player, something new, make sure you're ticking all the other boxes, because you don't want to waste time talking about, gee, who's your administrator? Who's your auditor? Who is your lawyer? Where are you getting this information from? You want to talk about your strategy. And that's why when I went to investors, and when I went to big investors, small investors, I went to them with an offering that said, okay, tick, 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 I know all these people. Tell me about your strategy. Tell me what's different. Tell me what you're doing that's different. Why is it a niche? Why is it a boutique? What are you doing that's different? Have the expertise of a Gemini behind you as your backbone, and then you will have a much more fulsome conversation with the investor. It's 60 minutes, that's all you get. And you may never get a chance to go back to see that person again. So make it work for you.
That's really nice, and making me blush.
Well,
So if you have, Ken, if you had 60 minutes right now, what are some niches that stand out to you that you'd want to talk to, us in this room to kind of convince that are some great niches?
well, I'll tell you what I wouldn't do.
Okay.
I wouldn't spend my 60 minutes on cryptocurrencies today.
Okay.
There are hundreds of guys with 5 years of experience, $5 million in their crypto fund, and I think that the answer is we just don't know yet. It's too soon, I'm not ready for it yet. I don't understand the administration of it. I read articles about cryptocurrencies, wallets being stolen and open, and that's all too cybersecurity worrisome to me.
Yeah.
What do I like? I like things where there is capitulation. We've seen tremendous capitulation in the commodity space. In historical, whether you could look at commodity ETFs, you can look at commodity hedge funds, you can look at anything across the commodity space, banks, everybody's getting out. I like that.
Yeah.
I like a business where everybody's running for the exits, where it presents an opportunity for the last man standing. So that would be one area that I like.
Carlos, you got an area, what's your niche? What you got? 60
He's gonna go for crypto.
Nice.
No, we're not investing in crypto. There's a saying that know what you don't know, right? It's very simple. And so we're not into it. We're not looking to get into it. For us, it really boils down to the point Ken was making. We say 30 minutes. I mean, you should be able to tell me, or a manager should be able to tell me in 30 minutes, what he does. And to me, it's not about numbers, because Ken and I were on the phone the other day. We're like, we look at numbers all day long, and I was going into looking at numbers knowing that they're not repeatable. I actually don't even look at numbers anymore. I just came back from Miami where we did MFA in context, and I didn't look at one track record before I had a meeting. It just didn't matter. To me, it's about the people. So when I first sit down to meet somebody, they really gotta, blow me away. And there's one word that we're always looking for, is originality. It's very simple.
It's a great word. So is there anything blowing you away right now? Is there anything that's...
Oh, we're a very big picture at Preqin,
Okay.
so we have been looking at hedge funds for a long time now, and it's been a really challenging few years for the industry. But it seems to be a good year. It seems like I think 2018 is going to be a decent one. When we speak to investors at the end of each year, the last 3 years, there's lots of negativity around the asset class, and lots of investors have been pulling back. But this year, we think, or what we saw is a lot of investors planning to put more money in. Lots of caution around the asset class as a whole, but they are trying to position themselves more defensively. So the institutions we work with are a bit more risk averse, probably, to Carlos, but they are looking at products like CTAs, very interesting at the moment. But things like AI is of real interest to institutional investors as well. They're starting to look at it. I think a lot of people think it's still a bit untested. It might still be too early for these models to really be fully AI, but it's definitely a conversation a lot are having in that space as well.
I just wanted to touch on something earlier about endowments and pensions and some of the bigger tickets coming into the space. They are looking. They're definitely engaged. But they're slower to market. I mean, they still take years to do their due diligence, they watch. But then if you notice our assets in our industry, once you break a certain threshold, to me, the magic number is like 500 million. From 500 million, they can go parabolic. I've seen guys go from 500 million, they've taken them 6 years to get to 500 million, and then actually know they're at 2 billion within 6 months. I mean, we see that all the time because, unfortunately, the institutional investor is optimized, because he doesn't want to lose his job, right? So he's optimized, and he's got to make sure that he's got a board to answer. He can't give money to a two-man shop that's maybe using, Gemini, all the right service providers. They're kind of a little bit reluctant, but once they break a certain threshold, they go parabolic.
What Carlos is saying is that they're trend followers.
Yeah, exactly.
It's that hockey stick we see all the time,
Exactly.
right?
We see it all the time, and to us, from an investor perspective, we watch that and monitor that very carefully. And I remember in February of 2009, we cut back a lot of exposure in the space we were investing in. We were getting called, like, why are you cutting back? Why? We're like, because it's just getting crowded, and we'd rather stay away from the crowd.
But let's be fair, Carlos, you also probably made a lot of money for your investors in 2008.
Yeah, that was one of
So
our
that's
best
another
years.
reason why that was part of the
Yeah.
conversation. We had a similar situation where in '08, we made a lot of money, but we also were an ATM because we had cash and a lot of people didn't.
So David, then that follows to you then. It's, what's the counterpunch here? Where are the crowded houses that you're seeing that you guys might be, or you're seeing folks shying away from, rather than perhaps running to at this point?
Well, I think it's interesting because where we've seen people running from for the last decade is what they're saying you should
Right.
run towards right now.
Yeah.
The CTAs, the managed futures, I mean, that space is going to be of interest right now.
That's right.
And I think.
Not last week.
Definitely not.
Care to provide
Last
detail on
week
that?
last week was a very tough week.
Last week gave back January, in many cases.
That's interesting. So let's talk a little bit about last week when you guys are sitting there and you're seeing what's happening. How do you react? How do you, because of the nimbleness, because of the speed, because of how you guys can move, does it put you in an advantageous position in a week like last week? Carlos?
Unfortunately, we were preparing for last week, and we
Okay.
thought we had the right exposure on it. And it's a week, I tell my guys, it's a week to remember, not forget, because it shows you what could really happen in this market. So we were positioned, we thought, correctly, and unfortunately, some of our managers that we thought would be positioned correctly were not positioned correctly. So we got hurt a little bit last week. We probably had one of our worst weeks in my 20-something years of doing this, but it is what it is. You can't, you're not that fast where you could, chase returns that way. You just gotta kind of like deal with it, suck it up, make sure you're properly levered. That's the key, is if I wasn't properly levered, then I'd be in a lot of trouble. So it's making sure you're properly levered when, because you just never know when those times are gonna come. So you have to survive in this business, and that's what it's all about. Because you can have 10 great years, you can be in this business for 10 years, 8 average years, you can have 1 bad year, you can have that 1 great year, and that's kind of what you're waiting for, is that 1 great year. Like Ken said, we had guys up 120% that week.
So, and that's what it's all about, is kind of being prepared. It's a week that kind of kicked everybody hard. I mean, look what happened to ETFs. I mean, it was kind of across the board when you're seeing these kind of outflows. Ken, when you guys go through a week like last week, what's the next step?
So, as a general statement, my experience tells me that if you make money in a week like last week, or you lose money in a week like last week, it's an accident. There's absolutely, in particular, a systematic trader, it's an accident. It is impossible to say that there's some predictability to what somebody does, that they're gonna make or lose money in a week like that. They may have made it last week, and the next time they will likely lose it, or may or may not, you don't know. Systematic traders are built generally for longer term type of situations. There are lots of short-term strategies out there today. The biggest difference of what's happened in the last 8 weeks is that we've had a significant pickup in volatility. There are a lot of traders, both hedge fund managers, systematic traders, discretionary traders, fundamental traders, that would say higher levels of volatility are definitely the friend of this industry. I recently you guys probably sat in the same discussion with Bruno Krastis of H2O, who's one of the more successful 20-some-odd billion dollar macro hedge funds in the business today, and he says, you're mistaken. Actually, low volatility has served us very, very well. through this period, and they've done extremely well over the last years. There's definitely a correlation between hedge fund performance and volatility being extraordinarily low. A 10 on the VIX is not likely to produce significant rates of return across the entire asset class. While as you get higher into the sort of 15 to 20 levels on the VIX, on the volatility index, you will have a more fulsome return over a longer period of time. I do believe that we are going to see higher levels of volatility. I think that that's as a result of the end of QE, the result of not this homogeneous global move towards QE. We now have different countries doing different things, which will create opportunities across the entire asset class.
So Amy, stepping beyond last week, as we look ahead to the rest of 2018, what are some sectors, what are some areas that have you particularly excited?
Well, to echo your point, I think the return of volatility is being seen largely as a good thing in the industry, and a lot of the criticism the sector's faced over the last 2 years has been that it's not outperformed equity markets, which isn't really the aim of most hedge funds, but it's an easy thing to criticise. And events like last week actually show the value of the asset class to investors. And going back to a point I made earlier, a lot of investors that are taking money out recently are looking to put that back in. They're trying to protect themselves. They are concerned there could be a future correction. They're concerned about kind of the health of the wider global markets, and that's where hedge funds can step in. So we are seeing capital come back in, kind of echoing the points I made earlier, really like CTAs. Yes. It looks like it's going to go into some more systematic strategies, CTAs. There are lots of investors that are chasing the returns that we saw last year. So emerging markets, for instance, kind of significantly outperformed developed market funds last year. And there's a large number of investors that are looking to tap into that. They tend to kind of get in with it's kind of performing very well, which might not necessarily be the correct time, but still a lot of interest.
So David, as we look out to the year ahead too, how does the boutique manager stand out? How do they shine as we head into what could be a volatile 2018? How does that boutique manager shine?
That's a good question. I think it's sticking to what they've done all along. I mean, and focusing on, what their message is around their strategy. And I wouldn't change what you're doing, at this point.
I think you look at folks like everyone here on this panel, and I think you guys have built a long and illustrious career by, doing things the right way and doing the things the way that kind of keeps you engaged with when markets are always been volatile. I mean, like you mentioned, 2008 was the way 2008 was, and 2009, and you guys have survived and thrived throughout all that. So what has you, Carlos, excited now as you kind of embark here on the future? What stands out?
Oh, that's an interesting question, because if I knew what strategy would get me excited, I'd be very, very wealthy today, and I'm not. So I'd be rich. So really, for us, it's you never know what strategy is going to outperform. It's kind of like you're betting on people, so you're hoping that the mix of people that you have on is going to smoothen out your equity curve. That's kind of what we're striving for. We just know that this is our business is a never-ending marathon. It's very punishing, and there's a direct correlation between trading and somebody's bank account. So you're kind of, you're trying to hit singles and doubles along the way. Every once in a while you hit a home run, but you got to make sure you get, you have the ability to get a bat. So that's kind of what we do. If that makes any sense.
No, it makes a lot of sense. I've always been a batting average guy over slugging percentage, so I think it's important to hit your singles and doubles.
I don't really know what's going to be great, but to his point, yes, volatility's coming back and things of that nature, which could be good, but definitely, everybody was talking about trend followers and crisis alpha and how they're going to protect you. Well, they've been long equities, so the trend followers that have outperformed the last few years, the reason why they've outperformed is because they've been long equities, and they all got really, really hurt this week. So, things like that happens, but anyway. So.
No, I think that's great. And Ken, what do you think? Do you have a good, strong outlook going forward? I think, we've kind of bounced around how boutique managers can be nimble, and that gives you an advantage here. Do you feel like that nimbleness is going to give you an edge to kind of head into the rest of 20?
I've never varied from that opinion.
Mm-hmm.
I've been a small manager investor forever, and it served me well. I do believe very much in what Carlos said, in that you need to find people that are good partners, people that are good to work with, that you really understand what it is that they're doing. I think that there's a lot of strategies right now that are going to become, and we talked a little bit about this, they're going to become disintermediated by quant, by systems. And I'm very cautious about getting involved in strategies like that, because I think that we make investments, and when we make an investment, we want to be with that manager for a long period of time. We don't want to. We're not really looking for a trade. We're not looking at it as a trade. We're looking at it as a very long-term partnership with that manager. And I think over the next 3 to 5 years, we're going to see significant shifts in AI, machine learning, quant, as it pertains to this business. And I think that there are going to be some simple strategies that are out there today that will be disintermediated by systems, and where a human being just will not be able to keep up. So we're very cautious about that.
Sounds like it's all about partnerships, being integrated. You mentioned before the backbone that Gemini kind of provides to all this as well. David, kind of driving this home, talk to us about how you guys are really helping empowering some of the great boutique managers out there.
The commercial.
Well, can you zoom in on him?
Nice. Nice take shot.
We have a platform that really is focused on providing the operational infrastructure. We don't opine on strategy. We don't opine on someone's trading methodology, anything like that. We provide operational infrastructure for managers to have access to the institutional level investors. The sabermetrics of your hedge fund, I mean, looking at which one makes the best fit for your portfolio, that is for other people to decide. For a portfolio manager, we provide exactly that, the backbone, all of the trading information, the documentation around the structure of the fund, and
Reporting.
Thank you.
Important. You see, I could tell a story better than he can.
It's much more important now than it was when Ken and I started 20 years ago. I still got 2 guys that work for me out of their bedrooms, believe it or not. They manage a significant amount of money, but it's totally changed. You need infrastructure now. And what you find is that you can't do it alone. A great quant or great brilliant mind needs a good number 2, number 3, and people like Gemini provide those services.
Having one-stop shopping is kind of a cool idea when you're a boutique. And again, as I said earlier, being able to tick those boxes makes all the difference in the world, because when you're a boutique, you walk in the door and they're scared out of their minds about who you are, what you do. So the more that you can make them comfortable about auditor, lawyers, all the stuff that David and his team do, reporting. People want to see what you're doing. They want to understand what you're doing. That's what they provide, and that makes the emerging manager, the boutique manager, all that much more credible.
This has been a really interesting panel. We got to talk about sabermetrics. We got to talk about being nimble, being fast, and being smart. And I think that's what keeps boutique managers a step ahead. So I want to thank you guys. It's been really interesting, and thanks for listening, guys. It's been fantastic.